Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will probably definitely love this channel. In this video we will be doing an analysis of Ingles and seeing if it would be a great addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, cue the logo. Let's begin with a brief review of Ingles, as many may be unaware of the company. Ingles is a regional supermarket chain with grocery stores, gas stations, and pharmacies in the southeast United States. Founded in 1963, the company is based in North Carolina and has about 200 locations, all less than 300 miles from its warehouse and distribution center near Asheville. In a departure from other grocers, Ingles owns its locations as freestanding supermarkets or entire shopping centers instead of leasing, and has been in business for over 60 years with a strong track record of profitability. Now, let's look at the price action. Starting with the 1-year chart, we see that Ingles had a CAGR of about -5.6%. Zooming out to the 5-year chart, we see that Ingles had a CAGR of 20.5%. This indicates that Ingles has had a massive upwards move in its stock price over the long term, followed by relative stagnation over the last several months. Now, let's take a look at the fundamentals. Gross margin is at 24%, which is really good for a grocer. Revenue has compounded at around 8% over the past 5 years and has topped $5.8 billion on a trailing 12-month basis. Very solid revenue growth. Looking at free cash flow, we see an 64.9% CAGR over the last 5 years, while capex has increased at a CAGR of 3.7% and stock-based compensation been negligible. With diminishing free cash flow and growing capex, Ingles appears to be spending more on maintenance capex while operating cash flow is returning to pre-pandemic levels. The challenge here will be to predict at which level free cash flow will settle. Next, weighted average shares outstanding have been trailing downwards, revealing that Ingles is actively buying back shares when the company is undervalued. They are buying back shares at a rate of about 1% per year. I really like this and hope they continue to buy back more shares, though the reduction in free cash flow may slow this. Now let's view my favorite metric, return on invested capital. Return on invested capital has grown from 8% in 2018 to 11% most recently. Again, here we would expect the return on invested capital to settle someplace lower than pandemic highs, perhaps between 8% and 10%. Another favorite metric is cash conversion cycle, a measure of operational efficiency at the company. Going from -31 days in 2018 to -0 days most recently, Ingles is demonstrating improving leverage. This is likely related to falling inflation reducing the cost of goods. Maybe the interest rate hikes are working. Last, let's explore Ingles' debt metrics. We will be looking at the current ratio, the debt to equity ratio, and the net debt to EBITDA ratio as we defined those terms in a recent video. For Ingles, the current ratio is 2.9, the debt to equity ratio is 0.2, and the net debt to EBITDA ratio is 0.9. The fundamentals of Ingles seem really good. Notably, the improving return on invested capital and cash conversion cycle as well as the debt metrics are great. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please subscribe, like, and share this video. Your support means a lot to the Food Fund and your continued viewership is a huge help to grow the channel. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Ingles. It is a grocery company with a gross margin of 24%. Great start so far. The 5-year revenue per share CAGR is 8% and the 5-year free cash flow per share CAGR is 65%. This looks amazing, but I would expect a return of free cash flow growth to more modest levels over the next few years. A return on invested capital of 11% is good. Next, the cash conversion cycle of 0 days shows very good balance. Concerning debt, A net debt to EBITDA of 0.9 means the company can pay off its debts with less than 1 year of EBITDA. This is very good and indicates that the company is very well managed. Now let's switch our attention over to valuation. Ingles is undervalued relative to the S&P 500 with a ratio of 0.3. The price to earnings growth, or PEG ratio, of 0.9 means that Ingles is relatively undervalued compared to its earnings growth rate. Very interesting. To wrap it all up, Ingles is a solid company with excellent management. It is not going to experience crazy growth but will benefit from the continued American migration to the southeast where the majority of Ingles stores are located from. I still think revenue and free cash flow may decrease in the near term and further pressure the share price, but there does seem like a buy opportunity near on the horizon. Let's put it on the watch list and see what else is out there. Many thanks for watching. What do you think about Ingles and its valuation? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.